Hello, you are listening to the Property Code Podcast, your practical guide to strategic real estate investing. Today we will explain how to build a portfolio of rental properties with almost no personal capital by using alternative financing schemes and straightforward performance formulas adjusted for the 2025 market. In this episode, you will learn the following. First, the key concepts such as seller financing, lease options, the buy, rehab, rent, refinance, repeat model, house hacking, and the role of government-backed home loans. Second, how to correctly calculate a return on investment, cash flow, and conduct financial stress tests. Third, a step-by-step algorithm of 5 strategies to scale your portfolio with minimal upfront costs. And finally, a detailed case study of a real investor operating in today's conditions. As of 2025, average mortgage rates have risen to around 6%, and property prices have appreciated significantly in many markets. The first strategy is house hacking using a government-backed loan. For a property priced at $250,000, your own funds amount to $8,750. You live in one unit and rent out the others. If the monthly mortgage payment is $1,500 and 2 rental units at $900 each generate $1,800, the net cash flow equals $300 per month. The second strategy is seller financing. Instead of dealing with a bank, you negotiate directly with the owner. The upfront option fee is typically 1% or 3% of the property price. The seller receives stable passive income while you invest minimal personal funds. The third strategy is the buy, rehab, rent, refinance, repeat model. First, you acquire a property at a discount, then perform renovations and improvements. After achieving stable cash flow, you secure new financing based on the higher appraisal value. You repay the original loan and reinvest the freed capital into the next project. The fourth strategy is equity partnerships. The operating investor contributes deal sourcing and management expertise, while the passive partner provides the capital. Profits are distributed according to a pre-arranged waterfall structure after reaching the target rate of return. The fifth strategy is lease options. You enter into a lease agreement with a purchase option, paying an option fee of 2% or 5% of the property price. A portion of rent payments applies toward the future down payment. This tool lowers the entry barrier and gives you time to accumulate funds or improve your credit profile. Now let us calculate the key financial metrics. Return on investment is annual net profit divided by total invested capital, multiplied by 100%. Cash flow equals rental income minus mortgage payments and operating expenses. Capitalization rate equals net operating income divided by property cost. For a stress test, simulate a 20% drop in rental income and a 10% increase in expenses. Here is the practical example. In early 2025, an investor named Marina purchased a property for $220,000 with a government-backed loan and an initial investment of $8,750. Following renovations, the value increased to $280,000. Upon refinancing, she released $60,000 in capital. These funds became the down payment for her second property. Today, her portfolio includes 5 properties, and the average portfolio return exceeds 12%. Thus, a no-money down approach is not a myth but a set of legitimate strategies that allow you to scale your portfolio without major cash outlays. Follow these methods, perform full due diligence, prepare legal documents, and analyze cash flow scenarios under different conditions. Thank you for listening, and join us next time when we explore automated advertising techniques and A/B testing of creative content for off-market deal sourcing and cost-efficient client acquisition.